Good evening, ladies and gentlemen. To introduce myself, I'm Pallavarajan, one of the founder of PMS Bazaar. Uh, it's delighted in welcoming you all for another insightful session. Thanks for taking your time in joining with us. Today we have Mr. Maran, who is an executive director for Unifi Capital, and he will be taking us through an interesting topic: Indian promoters are the best contrarian, or they buying now? So before I hand over to Mr. Maran, let me give a quick introduction about Unifi Capital and about Mr. Maran. Unifi Capital is a specialized PMS firm with a long-standing experience of 20 years headed by Mr. Sharpreddy, headquartered in Chennai and offices across key metros in India. Unifi currently manages an AUM of about close to 5,000 crore, where 4,000 crore in PMS and balance rest in AAF, with 3,000 plus clients. Unifi is fully employee-owned firm, and they don't have any other business other than the fund management. Unifi is one of the top 10 discretionary PMS in the country. And about Mr. Maran, Maran began his career in equities investing in 1991 after dropping out of college. After 10 years being with brokerage firms and banks, he joined a team of 4 to found Unifi Capital in 2001, based in Chennai. He has been spearheading Unifi's initiative in developing niche strategies like spin-off, holdcos, and one that shadows insider purchases, one in green businesses, and recently one that invests in businesses being disrupted. His fascination for fact-based assessment that differ from perceptions make him to travel across India. He shared these insights in educational institutions, industry forums, investor association, and policy-making bodies. So, good evening, sir. I welcome you for today's webinar, and over to you.
Thank you. Thank you for the generous introduction, Pallavarajan. Always a pleasure to connect with investors, do presentations based on some unique characteristics India has. Like many other businesses, fund management as a business also, many of us borrow the pattern of analysis from Western markets. Some that work globally works in India also, but many that works globally doesn't work here. And many of our investors, as well as other stakeholders in the industry, somehow seem to know more about Western markets than about India, our own country, which actually prompted us to do something called the KYC series. The KYC that we are all familiar with is more a regulatory one. But this KYC, what we mean is know your country. So I must have gone around whole of India, 2-3 occasions outside India, and did this presentation. Quite a few of those presentations are also in the YouTube. If you just type know your country and my name, you will get few of those videos, mostly done in a Q&A format. And it's not surprising to know that most places where we go and present, out of 20 and odd questions that we ask, either we get 5 or 10 or 11 correct answers. That gives you an ample indication of how little we know about our own country. And this one topic also is something which is unique to India. So what I will do is I'll run through the presentation, focus on just 2-3 specific the data points and how to interpret them. Is there a way where we can make use of such interpretations while pursuing investment ideas? How come promoters see value and opportunity when investors see only risk and uncertainty? It's a long title, but when we wrote to our investors a few months back, when we had seen a significant decline in market, and fund managers, media, and most analysts are talking about India, economy, macro, global events, interest rate, currency, COVID, lockdowns. Whole world was in some kind of a paralysis. People found it hard to decipher these data points and act. And that's when we sent a brief one-page note. It was a brief letter, but it had a long title, and this was the title. Before we get into insiders activity, promoters, we need to get clarity on who are all the insiders. When we look at companies, owner management basically is the promoters, the shareholder managements. Executive management is the board, CEO. Why this distinction we need to make is both we call as management, but both are slightly different. If you look at most Western markets like US, Europe, owner management is completely different. Executive management is completely different. Whereas in India, more or less both are the same. Maybe if you take the top 500 companies in India, which is close to 94-95% of our market cap, you may find in about 370 plus companies, the MD is either the promoter or appointed by the promoter. And therefore, owner management and executive management remain more or less the same. Whereas in US and most Western markets, ownership management is mostly institutionalized, and executive management will be an independent board, its own CEO, its own professional business managers. Today, our market capitalization of India is around $2 trillion. When we began 2020, 1st January, it was close to $2.2 trillion. By 31st March, post-COVID decline, it had declined as low as about 1.7. Now we are back to close to 2 trillion. We have about 1,900 plus companies trading in NSE, many more in BSE. And the entire market capitalization of all these 2,000, 3,000, 4,000 companies put together is this $2 trillion market cap. The top 30 Sensex companies are about half of India's market cap. The top 50 Nifty companies constitute almost 2/3 of India's market cap. The top 100 companies, what we call as large caps, they are close to 80% of India's market cap. And the top 500 companies is almost whole of it, 95%. This is not something recent phenomenon. About 2001, when we set up Unifi, if you take then prevailing market cap, the top 100 companies were almost 82% of then prevailing market cap. And in 2005, 6, 7, when small mid caps did well, market capitalization grew. The top 100 companies in 2007 was about 72% of the market cap. In 2013, it was almost about 82% of India's market cap was top 100 companies. In 2017, it was hardly 70% only. So effectively, in the last 20 years, the skewness of India's market capitalization in favor of few large companies always existed. Between 70 to 80% of India's market capitalization have always been in the top 100 companies. Today, maybe if you take the top 5 companies, that's almost 25% of India's market cap. Extremely skewed. And how this market capitalization is owned. If you take this $2 trillion, that is the cumulative value of all the stocks which are listed in the listed companies, about 55% of India's market capitalization is actually held by promoters. 20% is held by FIIs, which include all FIIs, hedge funds, endowment funds, sovereign funds, all put together. The DIIs, which means LIC, mutual funds, AIFs, private insurance companies, pension funds, all put together, own 13% of India's market capitalization. The rest of the people, you, me, portfolio managers, PMS schemes, investors, family offices, all non-institutional, non-promoter shareholders in India, they own 12% of India's market cap. This is the total as a percentage of the total. Maybe in few companies like say TCS, DMART, promoter holding maybe 75-80%. Maybe in few companies like Infosys, it may be less than 10%. Maybe in few companies like HDFC Bank, FII's ownership may be 50-60%. And there are quite a few companies where there is no FII ownership. But if you take the total market capitalization, FIIs own 20%. But if you remove the promoters holding and look at only the free float, which is 45% of market capitalization, FIIs own 20 out of 45. That's almost about 45. So they are dominant. And that is why their entry, exit gets reflected in the way the markets move. But if you look little closely, this 20% of India's market capitalization, 2 trillion, in value terms close to about 400 billion, $500 billion. that is again very skewed. Almost 1/3 of FII investments in India is in hardly 4 companies: Reliance, TCS, HDFC Limited, HDFC Bank. Those 4 companies FII holding is 1/3 of FII investments in India, little more than $100 billion. In Nifty, the other 46 companies in Nifty will be another 50% of FII investments. So out of this 20% Indian equities what they own, 80% of that 20% is in Nifty 50 companies. And which is why significant FII selling, significant FII buying gets reflected more in Nifty than in broader markets. But when it comes to the promoter stake, the top 100 large caps promoters may own about 53%. The next 150 companies, mid caps promoter stake is about 59%. The next 250 small caps promoter holding may be 56%. So somewhat evenly spread promoters holding. Unlike FIIs, where the red may be 80% of FII investments, the orange may be 10-15% of FII investments, and the brown may not even be 5% of the FII investments. If you take, say, mutual funds in India, there may be 41 mutual fund houses, 27 lakh crores AUM, 14 lakh crores in equities. But if you take the total 14 lakh crores in equities, the red may be about 75% of total equities mutual funds own, maybe large caps, and maybe 10-15% in orange. Whereas the promoter holding is somewhat evenly placed. Is that so in other markets? Is US also promoters own 55, FIs, institutions own 20 plus 13, 33%? No. For example, if you take the top 30 companies in US, Dow Jones Index, in Dow Jones Index, 28 out of 30 cents Dow Jones companies, 28 out of 30 companies. You can't find promoters holding in double digit. There will be 5, 6, 4, 3, like that. In 28 out of 30 Dow Jones companies. Whereas in Sensex, 23 out of 30 census companies, promoter holding will be more than 40, 50, 60, 70%. This market capitalization of 2 trillion that India has is 7th largest in the world, market cap. But if you take those 6 markets which are larger than India, in no market you will find promoters holding being more than half of the market cap. So that's very unique to India. If that is the case, there's so much of media interest, literature, studies. On daily basis, we track what FIs buy, sell, what DIIs buy, sell. But we don't seem to notice much of what promoters buying, selling. It may look like promoters are not that active. Obviously, if you take the last 5, 10, 15 years, promoters holding in companies may look like moving from 55 to 58 to 51. But each of that 1% movement, 2% movements could be substantial, could have a substantial impact. So our whole presentation in the next few slides, we will focus our attention to what promoters action is and how to interpret them. If promoters in Western markets own single digit, 5%, 6%, 7%, like that, who owns equities there? Today, if you take US, market capitalization of US is close to about $32 trillion today. And almost 80% of that is owned by institutional funds. And if you take S&P 500, that's 80% of India's US market cap, and 80% of that market cap is owned by um, institutions. How do promoters increase stake? When they increase stake, how do promoters decrease stake? We all notice when promoters dilute. How do promoters dilute? They either sell in market, which is very rare, but they sell whole company, whole stake in the company, that we often come to know. Sometimes company dilutes and therefore promoters take. Promoter would not have sold any stock, but the number of shares issued by the company will go, and therefore their stake on the company will decline. All this get a lot of attention. But promoters increasing stake, there are different ways. Most prominent of them are these 5. First is creeping acquisition in markets. Well, within the regulatory limitations of SEBI, there are 2 broad regulations: Substantial Acquisition of Shares and Takeovers Act and Prohibition of Insider Trading regulations. So when a promoter buys or sells stock in the company, it should be informed, notified to the company, and company in turn has to notify to the stock exchange. And before results blackout period, they cannot buy, sell. And if it is more than X percentage, it should be separately disclosed. And there is a limitation through which they can buy, like 5%. If your stake is below 55% in a company, you can keep increasing 5% a year, every year. But if the promoter is already owning more than 55% stake in the company, he can increase only 5%, not every year, cumulatively. And if he needs to increase the stake more than this 5%, then he has to come out with an open offer, tender offer, then increase stake. So there are various routes people follow. But in all this, they have to buy in market. If the appetite to buy is significant and what is trading in market is not so much, then they will make the company to allot preferential shares or allot warrants. But again, this will be governed by the regulations. The price at which they get the shares should be higher than 2-week average, 6-month average, closing prices. And fourth is rights issues. That's a little odd. Unlike preferential issues and warrants, which has to be higher than 2-week average, 3-month, 6-month average. Let's say March market falls and promoters increase stake, still these issues have to take into consideration pre-decline prices, and therefore such issues could be at significant premium to market price, which promoters may not be too keen to pay such a high price. On the other hand, the rights, there is no price restriction because rights by nature is supposed to be for all shareholders. Whereas in preferential issue of shares or warrants, because it is preferential, not for everyone, it has to be higher than SEBI stipulated price, whereas rights can be at more or less any price. But even though rights is for all shareholders, we all know at certain market conditions, not everyone subscribes to their entitlement. And promoters use this as a route to increase the stake. by subscribing in these rights issues more than their entertainment. It's funny, last month there was a company, reasonably well-known company. The market price was 180, 190 and the rights issue was at 50 rupees. And many retail investors did not subscribe and promoters subscribed more than this entertainment and his stake in the company went up. The last method promoters use in all these four cases, creeping acquisition, preferential shares, warrants, rights, promoter has to commit capital, invest money. But in the last thing, the company may use its money in buying back the stock. And such buybacks, any shareholder can tender. Promoters in many cases choose not to tender, in which case the total number of shares in the company decline and promoters number of shares they own remain the same and therefore their stake goes up. So promoters stake in these companies increase without promoters committing new money. There are quite a few companies where the company may be cash rich and instead of distributing the cash earnings by way of dividends, they may do buybacks. And in such cases, promoters also tender their shares. That's more for tax reason. But we look for opportunities where companies keep doing buyback and promoter not tendering the share. It's indirectly he's increasing stake. All these methods promoters use to increase the stake, which we notice. Probably this is the most important part of my presentation. The red line is BSE Midcap Index. The blue bars are the number of companies where promoters increase stake within BSE 500 companies. And here what you will notice is in 2008, when Sensex fell 50-60%, Midcap Index fell 70%. It basically fell from 10,000 to 3,000. And when markets declined sharply, in October 2008 is when this bottom was touched. We had seen almost about 120 companies out of BSE 500 alone, promoters increasing stake. But when markets quickly bounced back in 2009, just after Congress government came back in the second term election, UPA 2 in 2009, some of you may remember when the results got announced in May 2009, market went up 20% in one day. And then those occasions you find substantial decline in the number of companies promoters increase stake. And whole of 2012-13, when markets declined, it was more a grinding down market for 2-3 years. You again had seen large number of companies promoters increase stake. But when index moved from 2014, the midcap index moved from 6,000, 12,000 to 18,000. Basically, midcap index tripled between 14 and 17. And 2017, the number of companies promoter increased stake was almost 10-year low. But that's when you will find mutual fund collection record high, FIA inflow record high, index record high, investor return record high, investor participation markets record high, and number of IPOs record high. How many IPOs in 2017? More than 54. That's almost one per week. Every week we had one IPO. But when midcap index started sliding down in 18, 19, initially because mutual fund regulations and SEBI regulations on mutual funds and small mid caps, they had to sell to invest in large caps. But on top of this decline, we had seen one more COVID fall. that is March 2020, when index fell 30%, mid caps fell a little more. We all know the biggest sellers were FIIs, but who are the biggest buyers? The number of companies promoters bought in March 2020 is second highest in the last 20 years after 2008. When March, most of us were paralyzed for action, not sure about what to do. Those uncertainties that we read in newspapers and televisions, promoters also read, but they tend to take a contrarian approach. When market goes up 100, 200% in 3 years, when valuations are attractive, the investor flow is fantastic, is when promoters dilute stake. But when markets crash 40, 50%, like it did between 18 and March 2020, and if you are a promoter and you have been running the company for last 10, 20, 30 years, you are likely to run it for the next 5, 10, 15 years. A 50% decline in valuation, some companies 50%, some companies more, some companies less, is a good opportunity to increase the stake. In general, this graph validates our belief that promoters are contrarians. Are they good in timing the market? Are they timing the market here? If you just go by the number of bars and the line graph of index, it looks like yes. But the fact is, they don't know what is market bottom. They also don't know what is market peak. But near the peak, you obviously find a lot of promoter dilutions. It's not that all promoters wait for the peak to dilute. They've been diluting. There were a number of IPOs in 2016-17 itself. In fact, last time we managed a fund based on this, I still remember the date, 21st July 2016, somewhere here. We did a conference call to all our clients announcing the closure of Insider, one of the funds that we were running based on this premise, and saying that we would like to sell all the stocks, close the portfolio, return the capital back. And that audio of the conference call is still there in our website under client communication. And that was 21st July 2016. So 21st July 2016, that was amply evident. By June quarter, when the shareholding pattern of these companies have to be filed within 2-3 weeks after every quarter is over, which means in the current quarter, what all the companies promoter stake increase happened, instead of tracking every day based on the disclosures these companies make, if you wait till September end, by 15th October to 21st October, all companies have to file their shareholding pattern. And if you had noticed in June 2016, the number of companies beginning to see dilutions was growing, and which is why we closed the fund. So why I am highlighting that is, even though the mid-cap index peaked in December 2017, promoter dilution started from July 16 itself. Similarly, promoters don't know the bottom. It is not that the bottom only promoters buying has happened. Promoter buying started as the decline started. So they are not perfect timers of market. They don't wait for the bottom to buy and peak to sell. But when valuations turn attractive near the peak of the markets, you begin to find more and more dilutions. And when valuations reach bottom, not necessarily at the bottom, but before the bottom or just after the bottom, you begin to find promoters increasing stake. The biggest buyers we all look at mutual funds, but promoters are also buyers. There are a lot of media coverage how about 277 companies promoters hiked the stake. If you go strictly by BSE 500 companies, almost 93 companies promoter stake went up. But if you look at these companies that promoter stake went up, they're all over the place in terms of sectors. But little more than half of these companies, about 56% of the companies promoter stake went up, are either zero debt companies or close to zero debt businesses, where the debt equity ratio was less than 0.5. And 80% of the companies that promoter stake went up had anyway low leverage, below 1:1. Why this characteristics has always been like this, not only in the recent pool of companies where promoter stake went up, but even if you take those companies in 2008 market crash and 2012-13 market crash, as well as March 2020 market crash, majority of the companies promoters increase stake will be zero debt or almost zero debt or close to zero debt businesses. Because in our industry, we often use the term deleverage, right? What is deleveraging? Diluting stake, raising money. What is the opposite of deleveraging? Which is spending money and increasing stake. That is leveraging up. So when a company does buyback, it is basically leveraging up. If you are already leveraged, how do you leverage up? You would be looking at deleveraging. So most of the companies which are not leveraged, which doesn't have much debt, where promoters are cash rich, they can make use of market decline to buy more of the stock. Same thing holds good for you and me also as investors. If we are fully invested, how do we make use of a market fall? But if the promoters don't carry debt, on the other hand, if they are cash rich, which means they are cash rich before the fall, they can make use of the fall. If you just take last 2 years, it is not that promoters bought only in March 2020. The number of companies promoters bought in March 2020 were very high, but there are few companies that promoters increased stake even in 2018 and 19. But you don't find consumer discretionary FMCG companies which actually did well in 2018-19. They were all trading 40, 50, 60 PE. And they are all best performing sectors of 18 and 19, and you have not seen any promoter buying there. On the other hand, if you take the sectors like auto, pharma, metals, these sectors did badly in 2018-19, and that's where you could find significant amount of insider buying. So not only promoters are contrarian in the timing of their purchases. As a group of promoters, they buy a lot in 2020 March and they don't buy in 2017 as a group. That is contrarian. But even those companies and sectors where these promoters actually increase stake, they are contrarians. With the disclaimer that this is just a name I took only to highlight what price points promoters increase and what price points promoters dilute. Many of you who have been in markets for a long time know how successful Motilal Oswal had been. Two founders, chartered accountants, started from scratch, built a great business. And they started in late 80s, early 90s and built a great business. But when did they dilute? They diluted in 2007, which is almost near the market peak. And then post 2008, when markets declined, Mr.R also declined. 1 year, 2 year, they didn't buy. But in 2013, they did a voluntary buyback. People are gladly selling their stock and promoters are increasing stake. And thereafter, the stock did 10x. And then 2017-18, due to Aspire Home Finance, some fundamental reasons, price declined sharply, kept declining. And after September 2018, when ILFS crisis happened, it declined very sharply and promoters did not buy. Thereafter, the business improved, the balance sheet quality actually improved. They made all the right provisions with regard to their fundamental weakness in their business. And actually, in the last 6 months, if you look at the brokerage industry, where Motilal is one of the most respected and leader, the brokerage business in the last 6 months hasn't actually grown, hasn't degrown, because your revenue is a function of the total volume. Total volume is number of shares multiplied by the share price. When share price fell, 30% volume declined. And when share prices increased, the quantity increased, volume went up. But if you actually go by the total volume in stock exchanges in the first 6 months of this year versus the first 6 months of last year, there is no material change. Media is writing that there are Robin Hood investors, people sitting at home, not having much work, and therefore they are doing trading. It's not right conclusion. And one of their competition company, let's say if you take ICS Securities, they announced in their con call that the first 3 months, 4 months, they averaged almost 1,000 clients per day, new clients onboarding. It is not that India is producing 1,000 new investors who are just coming to one brokerage firm each day. But if you look at the broker number 21 to broker number 100, their volumes actually in the same period have declined. When the volumes of Zerodha went up 50-60%, ICSA went up 40-30%. So the brokerage business has been actually shifting from small regional undercapitalized brokerage firms to large, well-capitalized tech-savvy brokerage firms. That's the reality. While the net volume hasn't had any material growth, there are few firms which have had 30, 40, 50% growth. And there are quite a few firms which have degrown. So when volatility goes up, margin requirements go up. And earlier as an investor, if someone is placing a 10 crores order and if I have to have 1 crore limit with the exchange to do the trade, when SEBI increases the margin from 10% to 20%, to do the same volume, I have to have double the capital. If I can't raise more capital, then I have to reduce my business by half. So brokerage business shifts to well-capitalized brokerage companies. And at times like this, when you have one COVID and market falls 30% and your stock falls like this, the company actually did a massive buyback. I don't want to focus too much attention here, but the point I'm trying to drive is when you buy only those companies where promoters increase stake, they outperform, but they also decline. It is not that companies where promoters increase stake keep going up. They go up, they decline. If they're small cap, mid cap, they fall along with small cap, mid cap. There are companies where promoters increase stake and thereafter you see sharp rise. There are also companies where promoters increase stake which doesn't move for 1.5 years and then makes a big move. There are also companies where promoters buy and doesn't. On the other hand, after promoters buy, the stock actually declines before making a move. And there are also companies where promoters buy, but the stock keeps declining. So we did this exercise. If you take last 15 years, all the companies where promoters take earn-out, how the stocks performed in the subsequent 3 years. Actually, in about 11% of the cases, the stock hasn't moved. even though you bought when promoters bought, you held 3 years and still your experience had been pretty bad in 11% of the cases. In 14-15% of the cases, the returns were hardly anything, single digit, neither here nor there. But in about 70-73% of the cases, the investor return was substantial. I don't want to put a number. That number is much higher. When you put any number which is 20, 25, 30% IRR, it's not sustainable. We all know. But when we put that number in a conversation, it goes and it gets anchored in the investor's mind. So the point is, it's not that blindly you buy because a promoter is buying, but because promoters buying, it should deserve our attention. And when you see significant number of promoters buying, it gives you enough clue about the markets and valuations. And when you see significant number of dilutions, either across all companies or many companies in a sector, like in the last 2 years, you might have seen significant insider selling in many of the NBFCs, many of the consumer staples, consumer goods companies, professionals, executive management, owner management, dilutions. If you look at this universe, we didn't take just last 1 year number. It is not just we take last March number alone, because it is possible that some of these companies promoters might have diluted stake in 2016-17 and increased stake in March 2020, and there is no net effective stake increase. So whenever we take the analysis, we look at the previous 3 years also. And any company where there has been a dilution in the previous 3 years, we remove it, even though promoters increased stake in March 2020. And therefore, our test pool will always have ongoing 4 years period that we use to evaluate. And in that, there are about 167 companies that come into the pool. About 17 of them are large cap companies, that is company number 1 to 100. And 22% of these companies are companies with a market capitalization between 101 to 250, mid caps. And close to 60% of the companies are company number 251 and above. And these are all the businesses. But when we say BFSI, it's not actually private banks. It's not, which is almost 30% of BFSI weightage. If you take Sensex, Nifty, many indices were private banks. Here it's mostly could be gold finance company, many businesses like that. This is the second most important graph in the presentation. Here you find 3 line graphs. The red is mid cap, blue is Sensex large cap, green is small cap. So the blue is nothing but Sensex movement ever since we were set up. The red is mid cap index. The green is small cap index. And it validates beliefs that we have in a rising market. Mid caps rise more than large caps. Small caps rise even more than mid caps. And in a market fall, mid caps fall much more than large caps. Small caps fall. And eventually in panics, they all converge. Again, in a rising market, mid caps rise. Small caps rise more. Again, in a fall, they fall more and converge. Again, they rise. But if you take an active look at January 2018, this is January 2018. What is so unique about January 2018 is, if you look at the previous 3 years, that is 15, 16, 17, the Sensex and Nifty went up 50%. And mid cap index went up more than 150%. Small cap index actually tripled, right? Almost 600 became 2000, more than triple. So 15, 16, 17, markets in general did well. Mid caps did far better than large, and small caps were rating up. And till January 2018 in India, we had no clear definition of what is large cap, what is mid cap, what is small cap. So in 2017, if we had shown a $5 billion company, Goldman Sachs will call that as a small cap. HDFC Mutual Fund used to call that as mid cap. And Unifi Capital used to call that as large cap. We used to call stocks based on our relative size. First time SEBI came with some kind of a uniformity in defining that, saying instead of defining a company based on an absolute rupees crores, how many crores the company's market cap should be to be called as large cap. Instead, what they said is, we'll put all the Indian companies in one list and the first 100 companies will be large caps. Today, the company number 1 is Reliance, which has 14 lakh crores, $200 billion. And company number 100, maybe let's say Muthoot Finance or MRF kind of name, which will be having say 26, 27,000 crores. So any company above 26,000 crores is large cap. And company number 101 to 250, mid cap. 250th company today may have 7,000 crores market cap. So 7,000 to 26,000 crores mid cap. Now, when SEBI came with this definition, SEBI also said it is up to the fund managers to define their schemes as large cap, mid cap, small cap. But once you make that definition, define a scheme by that, the benchmark should be relevant and your holding should reflect that, which means you should not call yourself as a large cap fund and show Sensex as the benchmark and then go and invest in small mid caps, which is what some mutual funds and many managers were doing, which is probably a reason why 80-90% of mutual funds outperform the benchmarks in 15, 16, 17, because the benchmark you are showing is something closer to blue line and some of the investments you are making is closer to red and green line. And same managers, almost 70-80% of those managers were not doing better than benchmark, not because good managers have become bad, but because your composition is reflecting today fairly, right? So when that regulation came, it is not only for future investments. All the existing investments that you carry in those schemes where you are recognizing those schemes as large caps and showing a large cap index as the benchmark. If you are holding small mid caps more than what is allowed, which is say hardly 10-20%. So if you are a large cap fund, 80% of a fund should be large cap. If you are holding more than that in small mid caps, more than 20%, have to sell them to buy large caps. So if you look at January 2018 and December 2018, you would have seen Sensex up 7-8%, Nifty up 9-10%. And during that period, mid caps were down 15%, small caps were down 24-25%. That's the only year you would have seen blue going up and red and green falling. Not in the previous 10, 20, 30 years of Indian history, not after that. Because that's one year we could have seen many people selling small mid caps and buying large caps, not because they felt that's the right thing to do, but because those funds have to comply with the SEBI regulations. So that's over. History began. 2019, you don't find that happening. Now you don't find that happening, right? But one thing you may find happening is, in March 2020, all the lines converged. Usually, small, mid, large cap valuation convergence happens in panics. It usually doesn't converge by blue going up and touching red and green. Convergence happens when red and green falls and touches blue. In 2001, September 11 attack, when there is huge crisis globally, India had its own Southeast Asian financial crisis, 2-3 prime ministers in 2-3 years. And GSEC yield used to be 14%. Government of India used to borrow at 14%. And Sensex fell 60%. Many IT companies like Infosys, Wipro, they all fell 70-80%. Panic. Markets converged. But the bounce back started only from 2003. Similarly, in global financial crisis 2008, all the lines converged by June itself. May 2008, bear stearns collapse, panic, they all converged. But the bounce back started only from May 2009. In 2012-13, we didn't have a global reason for the fall, but Indian rupee lost 20% versus dollar. Inflation was in double digit. G-Sec yield came almost 9.5 double digit. And this is last 2-3 years of Congress government scam and many other stuff. And that is a year which was coinciding with the FCCBs that Indian corporates raised in 2007 with the 5-year bonds coming for maturity. And there's no FCCB market which was active in 2012-13. And many Indian companies had to do domestic borrowing to return their obligations in FCCB because 80-90% of those holders didn't ask for equity conversion. And what was conceived by promoters as equity became debt obligation, and people had to borrow in domestic markets to return these obligations. And almost about 1.5 lakh crores additional borrowing by corporates increased the rates and valuations declined. But the bounce back happened only from 2014 when Modi ji election happened. So the point to note is, whenever there is a convergence, the bounce back maybe in 2001 to 2003 it took 1 year 6 months. In 2008 it took almost 1 year 1 month. In 2013 September it took hardly about 8-9 months. Now it didn't take any time. It just vertical lift off. But from the convergence point, what bounces back sharply? Here, if you see in 2003, blue went up, but green went up a lot more. What looks like a small green line is about 140% from April 2003 to April 2004. Similarly, after convergence in 2008, when the bounce back started from May 2009 to May 2010, it's almost about 130% in small caps. Similarly, in September 2013, when we had convergence, the next 1 year rally in small caps is almost 110%. So it's not that in convergence point, large caps rise the most. Post convergence, the bounce back is very sharp in small mid caps. Not because small mid caps is a great place to be in panics, but because before the panic, they would have fallen the most. And therefore, this sharp green and red line. But you might have seen many experts recommending in March and April that you should be with leaders because large tends to grow larger, small gets thrashed, all that. But many times as investors, we confuse leaders with large caps. Both are different. There are several large caps in India who doesn't have any leadership quality. There are several small mid caps in businesses which are leaders in the business they operate. There are hundreds of businesses in India where the largest player in that business is still a small cap, mid cap. And they constitute this bounce back and very, very sharply. It's been a pleasant journey. So the last part, should we therefore buy when promoters buy? Actually, not necessarily, as I mentioned. Not all companies promoters buy, we should buy. But should we look at these companies that promoters are increasing stake? Of course, yes, because many of these names otherwise will not come into our radar. Is a pattern of promoter activity a better reflection of market valuation rather than 1, 2, 3 discrete trades? Answer is yes. We should see pattern of promoter activity, which gives us far conclusive evidence of the market valuation than any other parameter that I am familiar with. Is a pattern of promoter activity in a certain sector, great valuation. You will see that contrarianship, like I explained about pharmaceuticals in 1819 and automobiles last year. But people often, you may find saying that, oh, this company promoter stake is 75, so it's good. This company promoter stake is 40, so it's not good. You should not look at the actual promoter holding in absolute terms. You should look at it in relative to what it was, how it has become. For example, if my net worth has gone up from 20 to 40 crores and your net worth has come down from 100 crores to 50 crores, at the end of the day, you may have 50, I may have 40. But who is doing well? Is a guy who actually moved from 20 to 40. Similarly, if someone's stake is coming in, promoter stake is coming down from 70 to 60, In another company, it is going from 50 to 55. The company where it is 55 is better than the company where the promoter stake has fallen from 70 to 60. So you should look at promoters holding in relative terms. Has it been rising up or has it been falling down? Just because promoter holding is falling doesn't mean it's bad. Promoters can sell for 100 reasons, but they buy only for one financial reason or two strategic reasons. There are only two reasons promoters increase stake. Strategic reason will come into play only if their stake is below 50. Financial reason will come into play for the rest of the time. But the reasons promoters dilute, maybe a senior management may be retiring, so he is wanting to sell. There are many CEOs who may not like to continue to have over ownership, rather over concentration on one stock in their portfolio. They may like to diversify, or they may have a genuine other business idea and they may need to raise money, raise capital for that. So they may have 100 reasons to sell, but they will have only one major reason to buy, which is financial. Thank you. That's my part. I'll be happy to take questions.
Sir, thank you. It was one hour highly insightful session. Thanks for taking us through. Before taking the questions from forum, we have collated few questions. So we thought initially we'll address this, then move on to forum if time permits.
Sure, my pleasure.
So my first question is that given the current run-up and considering the promoters have bought up 2 quarters at relatively much lower prices, is there still value?
See, promoters bought significantly in March 2020. And there are quite a few companies promoters have continued to buy in April, May, June. So much so, this year, if you actually look at, the financial year gets over on 31st March. And the companies had to announce their audited results in April, May, June. And SEBI gave one extra month time for disclosure of results. And therefore, companies can announce audited results even by July. But when SEBI gave that extra 1 month's time, many promoters went to SEBI asking for one extra month for them to buy. As you know, when financial year gets over or on 31st March, and if the company is announcing results in May, the promoter is not supposed to buy from 1st April till he announces results, because the period is over and he is in possession of price sensitive information and it's a blackout period. But after announcing the results, he can do buyback. He can increase the stake. He can do creeping acquisition. So when SEBI gave time for companies to announce the results, many promoters actually went to SEBI saying that we should be allowed to increase our stake by doing market purchases, which SEBI declined. The reason I highlight that is the promoter buying was also there in April, May, June. It is not that we buy only those companies where promoter stake went up only in March. We look at companies where promoter stake went up even last year. Today, if you take those companies where promoter stake has gone up, of course, they all have moved up 20, 30%, maybe more in few cases. But almost about 40% of the companies that are in our universe are companies where the current price is lower than the price at which promoters have bought. And between 30 to 40% of the companies are companies where the stock prices are between minus 20 to plus 20 from the price at which promoters have bought. Maybe 20 to 25% of the companies are the ones where the current price is more than 20% away from the price at which promoters have bought. Now, if I am buying these companies because promoters have bought, my return expectation is 10-15%. No. My return expectation is significantly high. So if my return expectation is say 100, 200 kind of number, and if I'm going to buy 10-20% higher than the price at which promoters have bought, it doesn't make much difference from that pay. So it is not that promoters bought in March, so I'm buying in September, so I'm paying a premium. I'm also buying companies where promoters stake increase happened last year. And as compared to last year, current prices are still lower than where they were last year. So I'm not buying because promoters are buying. These companies are coming to our attention because promoters are buying. and I will buy because I see future earnings growth in these companies. So I may not buy all the 94 companies promoter stake went up in March. I may buy some 10, 15 companies where promoter stake went up a year back or 2 years back. Number one. Number two, if you are buying just because promoter is buying, then you should be buying in March itself. And how do you know which company out of these 94 companies you should buy? Then you can buy, if you can buy all the 94 companies, then that's a good approach. So if someone had bought 1 lakh rupees worth of every stock where promoter stake went up, and they just bought whenever promoter stake went up in the last 10 years, their return would have been fantastic. As I mentioned, only in 11% of the cases, they would not have made money. But in majority of the cases, they would have made money. But that means you should be buying 93 companies, 1 lakh rupees each in March 2020. And you should be buying only 11, 12 companies in 2017. Which means your total capital investment in small mid caps in 2017 would have been only 10, 15 lakhs. And it should be 1 crore today. Even that way, your portfolio return would have been fantastic because your capital investment would have been inversely correlated to the market valuations. If you don't do that, then you should do stock selection. Stock selection requires time. You would be rather happy to buy 20% higher than the price at which promoters bought, but eyes wide open, being convinced about that company and its future earnings growth. So that way, we need not have to get obsessed that March promoters bought, so I'm buying in September, but I may end up paying premium. I'm also buying various companies where promoters did not buy in March alone. They also bought March 2019. They also bought in September 2018. So that way, almost about 40% of the companies that we are considering are the ones where the prices are today lower than the price at which promoters have bought in the last 2 years. Yes, sir.
Thank you, sir. So the takeaway is that still there is an opportunity.
Of course, yes.
So my next question is in line with that. So how does investor capitalize this opportunity? You mentioned that you had a product, trying to capture this opportunity, and you have closed this product in 2017 July. So is there a product which is available with you to encash this opportunity?
Of course, yes. First time we did that was in 2008, 2009. When obviously global financial crisis market fell and a large number of companies promoters increased stake. But many of those companies were also Indian subsidiaries of MNCs, and promoters were increasing stake, which is basically MNCs. So when we did that fund, we called this as delisting fund. And many people in India, investors, if you talk about MNCs, they immediately get a picture of Nestle, Hindustan Lever, Colgate, Gillette, those kind of companies. These are all, of course, well-known companies, but there are so many companies in India those days, like Atlas Copco, Ingersoll Rand, Carrier Aircon, Abbott India, Solvay Pharma. These are all companies whose parents globally are 50, 60, $100 billion companies, but in India, they were small cap, mid caps. And we built a portfolio and called it as delisting fund. And we said when promoters buy, we buy, but when they dilute, we'll sell. But within 2 years, the portfolio did some crazy IRR and we closed and returned the money. And then again, 2011, 12, 13 market fell, we launched. But this time our experience was quite surprising. Second time when we did insider shadow fund, our first year return were actually minus 20, minus 23 or 24. Which means when you buy, when promoters buy, it is not that price won't decline thereafter. Maybe in March, promoters bought and then price went up. But when promoters bought in March, they were not 100% sure it is going to bounce back in April. It could have continued to decline. And had we bought, it could have continued to decline. Which means buying when promoters buy doesn't mean your next 6 month, 1 year return can be positive. It can be negative. And living example was our own fund last time we did. But in 2016-17, when we closed that fund, if you actually, that audio is still there in our website on 21st July 2016-17. If you open that, it's a 30-40 minutes audio where we clearly said that the portfolio has gone up something like 71% in 1 year. 3 year IRRs were 30, 5-year IRRs were 26, and this is not sustainable. And most of this growth has come not just because promoters bought, but they were all small mid caps, and small mid cap index was rising, and promoters were making use of this opportunity to dilute. The number of companies which filed the red herring prospectus with SEBI in 2016 crossed 100, more than triple digit. So these are all future IPOs. Clear indication of future dilutions. It's a good time to sell, which is what we did. Now we are redoing. Investors, not that all investors should look at it, because promoters are contrarians. For example, today you may find a brokerage company promoters increase, which I showed in the graph. And today, post-COVID, everyone says, no, aviation is gone, hotel industry is gone, entertainment, theater, all this is gone. But you will be seeing promoters buying in Indian hotels, which owns Taj Group. It's not that they don't know about slowdown. The room occupancy rates would have fallen from 80-90% to 10-20%. And in a trade like hotel, where you have 50-60% of your costs are fixed, when your revenues decline from profit making, you may get into loss making, and you have no clarity when normalcy is going to come back. But promoters are contrarians. They buy at times like this when the price overreact to a negative news, from 150 rupees when it falls to 60 rupees. And 60 rupees is 2007 price. 2007 to now, the last 13 years, 11 years, the company would have been profitable, growing earnings, accumulated reserves, which the company would have used in paring down the debt. So balance sheet is a lot better today than what it was 13 years back. But if you are getting the same price, which is 10-year low, 11-year low, is when promoters actually aggressively bid up. So you should buy. So contrarian investing may not suit all investors. It may sound sexy, and our experience have been pleasant, but it's not pleasant every day. It can see -24 and +71 as yearly returns. And there are some investors who may have a stomach for that. They can make use of these opportunities. And regular investors who would like to see returns in relative merit to an index, because that's another curse in our industry. Most investors evaluate an instrument saying that, okay, what is the alpha? What is the beta? How much is the outperformance? Index is up 20, this fund is up 30. That kind of approach in this strategy will fail miserably. Is it possible in this strategy, index goes up 20% and we go down 20%? Very much possible. But is it also possible that index doesn't move anywhere and this portfolio goes up 30%? That is also possible. So if you are an investor who is willing to take a 3, 4 year, 5-year outlook, and you are understanding the contrarian nature, and you see the volatility in a positive stride, and you don't measure the return in relation to any benchmark, but on an absolute return, then I think such investors will find this quite an interesting proposition. Yes, sir.
Thank you, sir. So there is an opportunity, and there is also a way to participate, to capture, to encash this opportunity through Unifi. Thanks for highlighting that, sir. So I'll move on to next question. In your experience, do you see promoters again offload the stake which they bought, or they keep raising stakes, or both?
Of course, yes. It is not that the same companies where promoters buy, we buy, and the same companies promoters will dilute in future, only then we'll sell. The type of companies promoters increase stake in one leg of the market could be different. And the type of companies where promoters dilute when the market valuations become expensive could be different. So it is not that the companies where we buy, when promoters buy, we buy. We will wait for those particular company promoters to sell for us to sell. Many of these companies promoters actually buy when prices decline, and they may not dilute when the price goes up. But if you see when market valuation going up and the company valuation going up, and you begin to see a pattern of promoter dilutions in several companies, that's when we start closing down the portfolio. Our selling will be driven by two factors. One is the pattern of promoter dilutions, which usually happens as an inverse correlation to market valuations. When markets are down, you find a lot of promoter activity, and suddenly you can give it in writing. For example, you pick one formula, cumulative number of companies promoters dilute minus cumulative number of companies promoters increase stake. It's a proprietary index that we follow. Whenever that crosses 0.5, it gives you a sense of more number of dilutions. Whenever it touches 0.7, 0.8, you know that a lot of promoter selling is happening and very few companies promoters buying happening. Or if you don't have time and patience to do all this in a professional manner, the manner that we do, just go by the indicator of IPOs. Suddenly, when you realize there are 20, 30 IPOs waiting to hit the market or actually hit the market, and all these IPO collection figures are record high, and FI inflow is record high, mutual fund collection is record high, it's typically a time you should get out. You should get out of not only inside the shadow kind of ideas, majority of the equity investment. You should be underinvested when everyone is euphoric. And which is why I continue to have this slide. Should you be bullish when everyone is bullish? Bull markets are actually born in pessimism. They grow in skepticism. And they mature in optimism and die on euphoria. Today, if you look around, we are not in euphoric conditions. We were pessimistic 6 months back. Even today, we are skeptical, which is when bull markets actually grow. When most people become optimistic, is a time this market will mature. And when people become euphoric, is a time we should just sell and come out. Yes, sir.
Thank you, sir. So the next question, does the extent of pledge share also give you some indication?
See, pledge is different. Promoter stake increase is different. If 54% of the company's promoters increase stake don't have debt at all, it is very rarely you will find companies with clean balance sheets and promoter as corrupted. Ulta you can find, not this way. Companies with zero debt and promoter being very rare. So 80% of the cases that promoter stake increase happens, the leverage will be very low, below 1:1. The incentive for promoters to pledge and raise money and complicate their life doesn't come. Majority of the cases where you find this promoter pledge complications are companies which are in high debt balance sheet, low return on the capital employed, and a lot of financial engineering happening in that. Financial engineering first will happen in the balance sheet of the companies, then before it happens at the promoter's individual level. So if you have one rule that I won't buy companies with high debt, 80-90% of these complications can be avoided. Of course, you may miss few opportunities. If you don't mind missing few opportunities and just say that I won't buy companies with more than 1:1 debt, 80-90% of the corporate governance complications, promoter pledge complications can be avoided. And I don't think we had any name in our universe, even a single name in our universe, with the promoter pledge issues. Yes, sir.
Fine. Sir, there are many participants who are very much interested to get your presentation, and more than a presentation, because I mean you have given a lot of numbers more than a narrative. So if you can able to share some insights, where to get those data. They're very much interested in the data, whatever you have shown. Is there any way to get the data? Is there, I mean, they need to pay huge money, like they need to buy a Bloomberg terminal and so on?
I don't have Bloomberg in our office, and I don't watch TV. We read simple newspapers, but we read extensively. For example, when 2 days back when GDP numbers came, people just read headline, GDP is -21, and market is at all-time high or near the all-time high. People get confused. But if you had just taken some trouble in just reading through that GDP -21, what brought down that GDP? Actually, if you ask people, how do you define GDP? People struggle. People don't realize that constituents of Indian GDP and constituents of Indian equities are different. Completely different. So people tend to think as if good GDP growth is good stock market. Never. I have one graph. In the last 20 years, we put GDP in x-axis and stock market in y-axis. There is no correlation. Between 2009 and 2014, India grew 8% per annum every year, and market didn't move. Between 2002 and 2007, India grew only 5-6% per annum, and the index went up 400%. Because what is GDP of India? GDP of India is 2.8 trillion, market cap 2.1 trillion, and people combine these two, say that this is cheap, this is sick. Because that is parameters they use in US, and we just copy it. In India, 15% of our GDP is real estate. 9.5% is construction. So real estate and construction is 25% of GDP. It is not even 2% of India's market cap. On the other hand, not even 6% of India's GDP is financial services, which is 40% of market cap. So if real estate and construction do badly, GDP will do badly, index need not have to. If financial services do well, index will do well, and GDP need not have to. On the other hand, if you just take businesses like IT and textile, when the GDP numbers came, it was quite evident. Indian IT industry is about $170 billion. And Indian textile industry, even if you put spinning mill, weaving, dyeing, garment, apparel, all this put together is little less than that. Okay. And last 1 year, IT has grown maybe 10-11% per annum. And textile has come down 10-11%. So the net impact of these two in GDP is almost zero. But in Sensex and Nifty, you have 5 IT companies and no textile company. So it is possible that index can go up as GDP keep not moving or keep declining. That is also possible. Look at this way. IT is slightly bigger than textile industry, but IT has 46 lakh employees and textile has 4.1 crore employees. And last year, when IT went up 10%, textile declined 10%. IT added 4 lakh employment and textile industry lost 40 lakh employment. So it is possible that GDP can grow and the unemployment can also be big issue. It is what is important is what is driving economy, what is driving market. And these are all numbers which is basic numbers which is available. So whenever there is an economic survey that comes, it's a long document and you just need to have time, patience and effort to put in to understand. And we don't need Bloomberg or any paid subscription in any websites for this data. A simple access to many of these industry association data, company annual reports, the disclosures different organizations make on our economy and different businesses as well as government. Amazing data points we have. Yes, sir.
Thank you, sir. Sir, small cap is generally known as high risk category when comparing with mid and large cap. So many of them is interested to understand what is Unifi view on a small cap, looking at next 3 years, 5 years, 10 years perspective.
So we should not confuse small caps with small companies. And we should not confuse large caps with leaders. This may look like an easy statement to make, but it requires some time to think and believe. There are several businesses in India where the largest player in that business is still a small cap. So from stock market capitalization point, they are all small caps. But in the business they operate, they are the largest players. Such companies will usually find amazing payoffs, right? But there are several large caps which may not even be any leader. They won't have any pricing power. They will behave miserably. So when you buy a stock, you pay a price and you get earnings in future. So P is equal to E multiplied by P divided by E. So price of a stock is equal to earnings per share multiplied by PE ratio of that share. This is the only ratio which is held valid 20, 30, 40 years back and even today. There are hundreds of other ratios which come and go based on the fashionable discussion topics, which means the price should move either when earnings of the company moves or the PE multiple improves. The earnings of the company is a function of the company, customer, vendor, supplier, competition, their own ecosystem. PE multiple is a function of market, sentiment, mood, demand, supply, FIA, action, all this. PE moves between yesterday and today. It moves between morning to afternoon, which is what is driving the share price. But the earnings of the company doesn't move every day. We come to know every quarter the results, but not every quarter results move in different directions. The earnings is more a business cycle. Business cycles are a little longer. 2, 3, 4 years your business do well, 1, 2 years business bad. So the earning cycle is much longer cycle. Over a long period of time, it is the earnings which will drive the price, not the other way around. Share price of a company could grow when the earnings of the company grows. But the earnings of the company is not going to grow because price is growing up. So if there are only two variables in a price, which is earnings and PE multiple is function of earnings, then it is better to track earnings. So if the earnings growth of a small cap is going to be more visible, more resilient, it is more safer than a large cap whose earnings you can't predict, right? So people try to narrow frame risk in terms of volatility, and volatility is not risk. If fixed deposit goes from 100, 108, 116, 124, and if ITC moves only with 10-20% standard deviation, whereas another company moves with a 30% standard deviation, doesn't mean that company with 30% standard deviation is high risk. It is high risk to people who don't know what is volatility or who can't understand why this volatility. But if you understand the company and the earning stream, you can benefit from the volatility. High volatility can be your high return if you know when to act. But if you don't know when to act, the same volatility could be a risk. So if you don't know what you are investing, maybe large caps are better place, where at least chances of default are less. It happens, but it's less. And volatility can also be less. But if you know what you are doing, then probably in small cap, what others perceive as risk is an opportunity for us. Yes, sir.
Thank you very much, sir. In fact, it was very insightful session, and in fact, thanks for your patience and addressing, most of the questions. So, would like to, if you can able to give some closing note for the investor and the participant.
Probably this is what 28, 29 years since I began investing from 91. I started my career with Madras Stock Exchange as a flow trader. While the degree of volatility has differed year to year, while the parameters people use in evaluating performance have changed time to time, while the nature of price movers have evolved over the years, one thing which has remained constant, if you look around the most successful investors, you can learn a lot of lessons from them. You need not to copy what they are buying. You cannot copy a conviction. But if you look around most successful investors, there are few learnings that you can get in terms of defining what is value, what is long-term outlook, why measuring returns in short periods could mislead us into doing few things which otherwise we should not have been doing. So these learnings are constant. There is no one inflection point you will say, no, I learned enough. But what is surprising is many times such learnings is not directly proportional to the years that you spend. There are people who spend 20, 30 years and never learned anything. There are people who just spend 3-5 years with sincerity and they learn. So the only point is, it's not that small cap is good, mid cap is good, large cap is good. You need to check what is good for you. Whether we cannot teach temperament, and you cannot change temperament by learnings. Temperament is somewhat unique to us, and we should do what is good in our temperament. And therefore, choosing products, choosing strategies should not be done based on obviously past performance. It should also not be based on others did it, so I'm doing. You need to evaluate what is right, and whether it is in sync with our own risk tolerance, whether it is in sync with our own return expectation. And when people say you should be contrarian, like be optimistic when everyone is pessimistic, and be skeptical when everyone is euphoric, all this is nice to discuss, but it's very hard to practice. If you find it hard to practice, you should not be even attempting it. And therefore, we never will position our products that this is great, this is bad, this is good. It is good for certain types of investors, and it may be bad for certain types of investors. So the only learning that as investors constantly you should endeavor to do is equip yourself in evaluating the opportunities in a very, very basic fundamental manner. If this 1.5 hours had highlighted that one aspect to you, I think I will be personally very delighted with that. Thank you.
Thank you very much, sir. Participants, thanks for your time. And I'm sure that this session would have been much insightful. Looking forward in hosting another event. If you need to have any more details on the product, you can connect us through info@pmsbazaar.com. We would love to address your query or whatever you need to understand the product. So looking forward in hosting another event. Have a great weekend. Sir, Maran sir, thank you very much.
Thank you. Sincerely appreciate. Thank you very much.
Thank you.